If you're one of those people looking into conveniently growing their money in the long run, then you probably heard of DeFi before. These days, people don't really want to leave their money in the care of banks as much as they used to. That's because banks, although credible, can sometimes have a lot of issues and therefore can be very inconvenient. So some people look for other options to invest their money safely and without hassles. That's when DeFi came into the picture. DeFi caught people's attention due to its simple process of securing and multiplying your money. The concept of DeFi wasn't popular until 2018. But is DeFi truly the best alternative to handling financial matters? Is it as safe as people claim it to be? Well, we think it might actually not be that safe. In today's video, we'll be exploring a few reasons why we think DeFi might not be as unproblematic as you think. Hey, welcome to Stock Market Mate. Today, we'll talk about the problems with DeFi. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. So what is DeFi? First off, let's dive into some of the basic information about DeFi. What is it? DeFi stands for decentralized finance, and what it means is that it offers financial instruments without relying on brokers, exchanges, or banks as intermediaries. This also means that DeFi is not controlled by the government. However, it doesn't necessarily imply that it is illegal in any way. It just means that here, the government does not have any say in the flow of the money and cannot dictate or limit what you can do with it. Instead, DeFi is governed by codes that perform the functions of a bank. Unlike traditional finance, DeFi is cheaper and they're open to anyone. How does it work? DeFi enables you to earn a return on your cryptocurrency deposits just like you would with a savings account. Additionally, you can stake your cryptocurrency with your funds, which supports the blockchain. If you wish, you can lend your funds to borrowers and earn interest or contribute funds to a capital. Regardless of what you choose to do, all of these options provide a return on your investment. Essentially, these are the reasons why DeFi is so popular among investors. Contributions to the system are used for a variety of purposes, both functional and financial. Through interest fees and promotional rewards from certain platforms, the depositors receive a return. Moreover, investors can engage in yield farming. Basically, this is their search for the best rates, and they frequently switch crypto into different applications. The approach, however, is risky when it comes to getting a new type of cryptocurrency. What's more is that DeFi lending platforms allows you to borrow money and purchase insurance against certain DeFi unfortunate events such as hacks. Now, DeFi's system usually can't be hacked, but it's still very much possible. But we'll get into that later. DeFi also offers the possibility of trading cryptocurrency for fiat currencies, trading derivatives, etc. The building blocks of DeFi. There are three main things that build DeFi. Number 1, cryptography. Number 2, the blockchain. And number 3, smart contracts. The protection of digital data is provided by cryptography. It consists of transforming data into formats that cannot be deciphered by unauthorized users. Next, we have the blockchain. A simple explanation of the blockchain is that it's a type of technology that records information in a way that is difficult or impossible to change and hack. Blockchain allows digital information to be recorded, distributed, but not edited. A blockchain can be thought of as an immutable ledger, or one that cannot be altered, deleted, or lost. Lastly, we have the smart contracts. Basically, a smart contract is a contract that executes itself after being governed by lines of code with the terms of the agreement between buyer and seller being written there. Smart contracts have allowed people to create decentralized applications, or dApps for short. From exchanging currency to buying insurance, dApps facilitate everything. These three major things make decentralized finance work. They essentially make up the anatomy of DeFi. Without them, it would be impossible for DeFi to perform its functions. DeFi versus banks. Originally, cryptocurrencies became well known through Bitcoin. However, most decentralized applications are hosted on the Ethereum blockchain, as Ethereum has more smart contract capabilities. In fact, the developers of Ethereum were actually the ones who coined the term DeFi for decentralized finance in 2018. Truly, DeFi's reputation has since then increased significantly over the past few years as more users have signed up. At the beginning of 2020, Ethereum's total locked value was just over $600 million. This jumped to over $110 billion in recent months. The growth is indeed pretty impressive. However, it's still not as huge as the larger financial system, which is the CeFi. In fact, approximately $110 trillion worth of assets exist in the world's banks. That's according to the Bank of International Settlements. This means that despite its cons, many of the people wanting to invest their money would still prefer CeFi to DeFi regardless of DeFi's popularity. When you think about it, DeFi is not really much of a competition. Still, we can't predict the future, and who knows what's actually in store for DeFi when it reaches more investors sometime in the near future. One thing we are certain of is that banks are undeniably gaining more assets than any financial systems worldwide. The cons of DeFi. But now let's talk about the main topic here, which is the problem with decentralized finance. There's a reason why many people still go to banks despite the claimed convenience of DeFi. The first reason is that DeFi is still relatively inefficient. That is especially true in their data processing. Why is this so? Keeping the blockchains active consumes large amounts of energy. In fact, Ethereum consumes about 60% more power during a single transaction. That's roughly more than 100,000 Visa transactions. Application building can also be cumbersome as it often requires a series of small programs rather than a fully contained program due to smart contract limitations. Transactions in DeFi also require you to pay gas fees, which are basically tips to miners of the system, which can be as high as $10 per transaction, even with the slow processing speeds. A complex DeFi function will also result in a higher gas fee. Systems to circumvent the issue has been developed, such as Layer 2 scaling as well as sidechains. While both involve the processing of data outside the Ethereum blockchain, it has only led to an overflow of different options for carrying out basic functions of DeFi. On top of that, DeFi also carries a risk. Since DeFi is still a new technology, with its functions still in the process of being worked out, many crypto enthusiasts believe that DeFi present a significant risk, especially for adopters. Cryptocurrencies are known for their volatility, and they are essential to these transactions. Hence, using a volatile asset to power a DeFi system would be counterproductive. Furthermore, DeFi does not provide any consumer protections. As mentioned before, it is still very possible for it to be hacked. Why this happens is because, as we all know, avoiding regulations also means operating in an unregulated environment, which means that if you lose your cryptocurrencies through scam, hacks, and other unfortunate events, you can no longer get your coins back. Although many aspects of blockchains are pretty well protected from hackers, there are still vulnerabilities that appear during functions that are part of DeFi. A critical factor here is the permanence of blockchains. Occasionally, smart contracts may contain bugs since they are human-coded. As a result, either the service will crash at times or holes in the security will be exposed for hackers to exploit. Hence, since data in the blockchain is permanent, the chances of fixing the faulty code is ultimately zero. With such flaws, there's no wonder why a lot of people still would choose to go to a bank rather than joining something that isn't as secure. So far, those are only some of the problems we've recognized in decentralized finance. There are probably more that we haven't mentioned. Regardless, it is still safe to say that when it comes to convenience, DeFi still tops. But for some people, it is not enough that the process is cheaper and more convenient. After all, we only want what's best for our money growth, hence taking the safer option might not be such a bad idea. And that's about it for today's video. We hope we were able to help you understand the risks that decentralized finance holds. For more videos relating to DeFi and cryptocurrencies, consider subscribing to our channel for more. Thanks for watching, and we'll see you on the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!